You've probably heard it before, when the market drops, it's the perfect time to buy. But is buying the dip really a smart move, or could it put retirees at risk? Today, we're breaking down the pros, the cons, and smarter ways to invest for the long-term financial security.
Welcome to Leibel on Fire with Amazon best-selling author and Yields for You portfolio manager, Leibel Sternbach. Leibel on Fire is supported by our ETFs, Yields for You Strategy A, and Relative Strength Managed Volatility. Our mission is to help 1 million people retire with financial security. Now, the Financial Independence and Retirement Show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Leibel on Fire.
Hello and welcome back to Leibel on Fire. I'm Freddie Bell, and I'm with Leibel Sternbach. He's Amazon's best-selling author of Living with Financial Anxiety and also the book entitled Authenticity. Leibel, it's so good to see you, and welcome back, sir.
Hey, how are you doing today?
Unbelievable, and I'm really excited because spring is just around the corner.
Yeah. Warmer weather, not so much with the markets, but what can you do?
Well, I guess you have to dip in or dip out. And you know what? Let's start there. What exactly does it mean to buying the dip, and why is it considered a popular investment strategy, Leibel?
Well, as our new Treasury Secretary says, to all this volatility, buy the dip. And buy the dip is the old adage when it comes to stock investing is that you buy low and you sell high. That's how you make money, right? There actually is no other way to make money, right? It's you buy low and you sell high. The thought process is, well, when the market has this pullback, right? And statistically, other than the last few years that have been kind of an enigma, we generally have 5%, 10%, 20% clawbacks of the market. They're regular occurrences, so regularly that there are statistics about them, right? Like 5% pullback usually happens every 3.5 months. 10% is like every 18 months. 20% is like every few years. And so the adage goes, don't get frightened when the market pulls back. Use it as a buying opportunity to buy the dip, right? That is the theory, right? Look at it as you're getting a discount on your investment growth. And, that adage works well for many people, depending on where you are in your retirement journey, right? If you're in the investing phase, if you're in the accumulation phase, then that is kind of how you generate wealth, is by buying when it's low. Of course, we'll talk about specifics, but that's the theory.
So is that prevalent early on in your investment walk, buying when it's low?
So yes and no, right? So there's something you'll also hear on Wall Street. Wall Street loves their sayings, right? We love confusing people, and we love having like these little pithy sayings that make it sound like, oh, it's just so simple. And so one of those pithy sayings that we love to tout is it's not timing the market, it's time in the market that matters, right? It's not about when you got in or when you got out, but it's how long you spent in. And what that does is it takes away from the idea that you can time when you buy into the market and when you buy out of the market, which used to be the thing that people did, right? Stock pickers, that is all they do, is they time when to go into the market and when to go out of the market. They say, I'm going to buy this stock because it is lower than it should be valued, right? And look at Warren Buffett, right? Warren Buffett has done phenomenally well. And all he does is he keeps buying good companies at a great value, right? He doesn't buy them at like an okay price. He doesn't buy them at like a high price. He buys them when they are low. And he keeps doubling down. When it gets lower, he buys more because, as he says, if you were going to buy it to begin with, right, then what difference does it make that it went down, right? It doesn't change whether it was a good purchase or not. And so when it comes to this buying the dip, right, and timing the market versus time in the market, there's a certain kind of like fallacy that we've promoted that individuals are incapable of timing the market. And statistically speaking, most people are incapable of timing the market. So what we tell you to do is instead you want to make sure you're invested for the long run. And so during our working years, the way this works out to be is we have our 401k and we're constantly contributing. Every 2 weeks, it gets taken out of our paycheck and we buy into the market. And so on average, right, and this is known as dollar cost averaging, we end up buying at lower prices, right, so that we end up buying the dip when there is a dip. But sometimes we also buy higher. So on average, we do better, right, overall. And so that, for most people, is the extent of buying the dip.
We're talking with Leibel Sternbach this week, and we're talking about the fallacy of buying the dip. And I'm curious, Leibel, how can retirees distinguish between a short-term dip and a long-term market downturn?
Well, ain't that the question, right? How do you tell the difference between whether this is just short-term volatility that the market is going to recover very quickly from or long-term? And the answer is that it's impossible to know, right? In a lot of ways, the market is a self-fulfilling prophecy. And so the market will make a prediction about the future. And then because it's driven by human beings, they become anchored to that projection of the future, and they will seek ways to make it happen. And it's a very interesting phenomenon to watch happen. However, as retirees, right, what we need to be worried about is we always need to be worried about the worst case scenario. What if this pullback is a long-term pullback? What if we have another lost decade where the market only makes 1%? And it's happened before, right, where there's been multiple lost decades over the last 150 years. And so the question really becomes, how do we make sure that this protects our retirement? How do we make sure that whatever's craziness is happening in the Wall Street roller coaster, that it doesn't affect our ability to retire and stay retired?
I like that, Wall Street roller coaster. We're talking about the fallacy of buying the dip. And Leibel, I'm wondering, does dollar cost averaging offer a more disciplined approach? And you talked about that a lot compared to opportunistically buying the dips.
So yes, it does. Dollar cost averaging is that thing that we do during our working years because we're constantly contributing to those retirement accounts and what's getting taken out of our paycheck. So every 2 weeks, we have money that's going into the market. So by virtue of the fact that we're constantly buying in every 2 weeks, sometimes we buy the dips, sometimes we buy the highs, but on average, we get a better average price than if we had just bought the dip or just bought the high point. Having said that, though, right, you have people who will wait and they'll sit on the sidelines with cash and they'll say, I'm waiting to buy the dip. The problem is that when you zoom out, the dip is only a dip in a short time horizon, right? So if you can have a dip within a few hours, right? And day traders, that's what they look for, right? They might have a 50% decline within an hour or two. But that 50% decline was relative to their starting point. And for the rest of us that are looking on a daily basis, that 50% decline was really like a 0.25% decline because we're not looking at the same kind of zoom level that they're looking at. They're zoomed in on the micro, on like a tiny little speck of dust on their microscope, and we're zoomed out. And so the further you zoom out on your time horizon, right, the less that you can tell what is a dip and what is just normal volatility, right? So the real question of buying the dip is, when did you reach rock bottom? When does the recovery start to happen? And when is it a false recovery versus a true recovery? And the answer is, it never is, right? You never reach the bottom because we never go to zero, and you never reach the top, and you only know about these things after the fact when you can chart it nicely and say, well, this is what happened. But when you're in the moment, very difficult to predict. There are people who do it. We employ a money manager whose entire strategy is he looks for companies that are going down. So when the market is tanking, he looks for companies that have strong value, like Warren Buffett, right? Sound fundamentals, but they're getting beaten up by the market because everybody is selling everything. And so you buy the thing that is stronger than its peers because when the market recovers, they recover better than their peers, right? So does he buy the dip? 100% he buys the dip. Does he try to buy the bottom? No, because he can't predict the bottom, just like nobody can, because that's one of those 20/20 hindsight things is we only know after the fact, just like a recession. We only know about a recession after the fact. Usually it's like 12 to 18 months after we're in a recession, do they declare, oh, we're in a recession.
So to use a sports analogy, it's like playing the entire game. You have to be in it for the long haul?
You got to be in it for the long haul, and you got to take a disciplined approach. Whatever your approach is, it needs to be disciplined, and it needs to be based on statistics, because if you are betting that every single hit you make is a home run, you're gonna fail, right? And unfortunately, when people bet that every single hit is a home run, that's called gambling. That's not called investing.
Leibel Sternbach with us this weekend. And what practical steps can we take, Leibel, so that retirees what can they do to balance that risk while returning and making sure that they don't outlive their savings?
Yeah, so it's a great question. And this is fundamentally the biggest question that we help people solve at Yields for You. We've got two mottos at Yields for You. The first one that's printed on all of our stuff, that's on my shirt over here, that says low risk, low volatility retirement solutions, right? So that is number one, right? Because that is fundamentally the key to solving that problem. The other one is we're on a mission to help 1 million people retire with financial security. So how do we ensure that we don't run out of money in retirement? It is extremely simple. Step number one is we need to make sure that we do not have a need to pull money out of the market when the market is down, right? Now, we don't have a crystal ball, and we're living off of this money, right? So we don't know if we're going to have an emergency that requires us to pull $50,000 out and pay for something. We don't know whether the market's going to be up or down tomorrow. And so we need to make sure that the money we're living on for the next year, 2 years, 3 years, that is not going to be affected by the market, right? That fundamentally, whatever the market does, it is not going to cause us to ever potentially have the issue of running out of money in retirement. We're never going to compound losses by pulling money out at the wrong time. So step number one is just make sure that we're not part of that paradigm, right? Buying the dip, selling the dip, who the hell cares? It doesn't affect our retirement. That is obstacle number one. Once you have that, then you can talk about, okay, how do we invest? Do we keep some cash on the side so that we can buy these dips? My favorite to do with retirees and people in retirement is we do tax loss harvesting. This is the best opportunity for doing tax loss harvesting. I've done more trades in the last week than we've done in the last year. And that is all because of this volatility allows us, hey, positions down by 10%. We're going to sell Coke and buy Pepsi because when the market recovers, we're going to get that recovery. But on our tax return, we get to take that loss. All right. So look for the opportunities that you can quantify and make sure it doesn't affect your income, because that is number one. Make sure that it doesn't affect your income. And that starts by having a good financial plan, a good retirement income plan. And that is the most important.
He's Leibel Sternbach, and all this information can be found at yields4u.com. Yields the number 4, the letter u.com. Got to leave it right there, Leibel, and buying the dips really sounds like a great deal, as we've discussed. But it's not always the safest strategy, especially for retirees. A disciplined, long-term approach can often provide more stability and, more importantly, peace of mind. If you enjoyed this episode, don't forget to subscribe, leave a review, that's really important, and then share it with a friend. Until next time, keep your finances smart and your fire burning.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yields4u.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.